Going to bring in Dan Greenhaus and how you should be positioning ahead of it as well. Dan Greenhaus is Chief Investment Strategist at Solus Alternative Asset Management. And so, Dan, this is one of those Fridays, in a little bit of a mini crisis period. It's kind of the fog of war. You can't disprove the idea that there's other shoes to drop in the banking system, but you also don't know for certain that that's going to happen. What's your read on the week's action in the context of what has had to occur with the banks?
Yeah, I don't know that you can really read too much into it. There's a lot of conversation about cyclicals outperforming and how gold is doing. And I think to your comment about this being in the midst of the fog of war, I think it's really hard to make any consequential decisions right now, since, to your point, we don't know when the next shoe will drop, if the next shoe will drop. And so I would be hesitant to read too much into just about anything right now.
The broad outlines of the way the markets are behaving is it seems as if, again, we're bracing for the recession playbook to kick in a sense, right? Oil cracking, even though you just said don't read too much into what the market's been saying. Oil cracking, two-year note yield plunging, market, at least on the surface, anticipating the need for Fed rate cuts in future months. You could go down the line, leading economic indicators, all the rest of it.
Having said that, let me amend what I just said.
Sure.
So I was talking about positioning within the equity market. Yeah. This is going up and this is going down. Unambiguously, the message being sent by the Treasury market, the oil market, is that there's a recession coming. And to be clear, the outcome of this debate in the regional banking sector, irrespective if you have one view or another about how it started, who started it, and all of that, you're talking about lower net interest margins, probably a curtailment of loan activity, lower valuations, blah, 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 blah. But on the decreased loan activity, that's going to do some of the Fed's work for it over the next 6 to 12 months. Because if you're a bank and you need to shore up your balance sheet, there's a couple of different ways you can do it, one of which is make a few less loans. And I think that's probably what's going to happen.
On one level, doing some of the Fed's work for it is not the worst thing in the world, unless it goes too far and all of a sudden we're in contraction mode. So how do you try to assess those probabilities?
Well, listen, regional banks only have about 40% of the country's deposits. They do about 50% of the lending, and whether they lend here or there or more is besides the point. A lot of lending activity is done at the regional banking level, and I know everybody's talking about who's exposed to office, who's exposed to commercial real estate, which of course is going to be where attention is going to turn. In terms of how to gauge this, I mean, you can do, I have not done it myself, but you can do economic analyses to say the level of curtailment of loan activity we think will lead to a couple of tenths of economic activity contraction over the next couple of quarters. I think that's likely to be the case. Admittedly, most everything is a couple of tenths off of economic activity. Just whether it's 2 tenths or 4 tenths remains.
It's a big economy. It's tough to move it far fast.
It's tough to move it far. Yeah, but so I think going forward, I think that should be your expectation. And to the point about the Treasury market and oil, I've been on here, as a number of people have, talking about the likelihood of a recession.
Sure.
I find it shocking that people are shocked that the Fed would hike by 500 basis points in a year and something would break.